Okay, so these 3 to 5 funds cover the asset classes of stocks, bonds, and real estate. So, for example, let's say that one of these portfolios was worth $2 billion, right? So, out of the $2 billion, let's say that they set aside $1 billion to invest in nothing but real estate. So, out of that $1 billion investment, what will happen is that they essentially expect a growth of that portfolio of about 5 to 7% yearly. Therefore, that's how you know that your investment will grow at a guaranteed steady rate. So it's just based off the fact that some industries are known to growth yearly, and there is a minimum amount that it grows at every year. That it's pretty known. It just depends upon the market, of course, but it just goes to show how they invest the money that people use to invest into those stocks. So ETFs are long-term certain vehicles that allow your funds to grow. Investing in ETF stocks is investing in diversified portfolios. So where do you put the remaining 25 to 40%? And that's referring to the $150. So just to remind you, so we invested 60 to 75% of this amount into these right here. Well, this was strategy number two. This was strategy number one. So in theory, you could buy all of these. So I'm just giving you these two as two different possible strategies, but you could purchase all of them, right? All the ones that you see here. So let's pretend that we are only investing in 3 to 5 of them. And by the way, how you can decide which ones to select, you basically will look at the historical data of how those stocks are performing. And I'll show you that later on. So let me just give you a quick glance of what I mean. So this is what I mean. So we'll look at the historical data to see, like how it has been performing, like on a yearly basis, as an example. You see what I mean? So that's how you can pretty much decide which one you want to select. So let's go back here. So where do you put the remaining 25% to 40%? So what you will want to do is that you will want to invest the remaining 25 to 40% into 8 to 10 individual stocks for additional returns. So what that means is that you will want to invest into stocks with dividends or hot new stocks about to blow up. So these are two different kinds: hot new stocks about to blow up and stocks with dividends. So that's where you put the remaining 25 to 40% out of that $150 that you're investing on a monthly basis. For dividend stocks, the reason why I am recommending them is that stocks, um, dividend stocks are stocks that have been around for a long time, since they come from established companies. So what happens is that these established companies provide payouts throughout the year. So if you were to select the correct dividend stocks, you could create a system where you are receiving monthly payments or perhaps even weekly payments from these dividend stocks. So now, in regards to stocks about to blow up, these stocks are companies that are not known yet, but they are investors in the process of investing into these companies. Essentially, what this means is that the companies will have a lot of funding available. At the moment, those stocks might be worth not so much, right? So the stocks are low price. What you will want to do is to check the news, right? If you can, you don't have to. It's just a matter of selecting the right ones. And once you find the right stocks, you just continue putting money into it. Now, regarding these, especially the ones about to blow up, you never know. The company could fail. It's a very possible chance the company could fail, but it's a matter of selecting the correct ones, and I'll show you how I go on to select the correct ones. So check the news and check the internet.